Welcome, traders, to After Hours at TradersPost for Friday, December 5th, 2025. I'm one of your hosts, Tom Hartman, marketing manager here at TradersPost, joined by Peter, Jack of No Trades, Hartman, to break down the market madness. After Hours is your go-to live stream focused on macro trends for retail traders. That's dollar, equity, and policy for the uninitiated. After Hours is brought to you today by Blue Sky, the best-in-class prop firm that offers same-day activation, daily payouts, and no max restrictions. But we'll tell you more about them later. For now, we turn to what's going on in markets today. But right before we do, Peter, I want to ask, how are you doing? How's it going?
It's going really well. Very happy. Very happy.
Yeah, it's been a crazy...
I'm especially happy because no F1... The season has ended, and top of the charts, the best AI model to trade is Grok 420. Oh, Elon.
Oh, wait, Elon. Grok 420 is what it's called?
It's 4.20.
I mean, it's like all the leaders now are children. They're all children. If it was the president, whether it's heads of companies or whatever, they're all kids. Interesting. Peter,
yeah,
it's been a volatile 10 years, let's go with. I'm going to go with about 10 years, maybe a little bit less than that. But essentially, ever since the COVID and the lockdowns, it's just been, for markets, a wild ride, right? When we had that V down in March of 2020, I thought, hey, we're going to head so much lower. We're going to be headed down into bear market territory. I'm going to make a bunch of money as markets fall. Nope, the exact opposite happens. The market went up, and then it went up again and again and again and again, higher and higher, 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 higher still. It's what made me lose a bunch of money and what brings me here in front of you today. Because if I still had that money, I would not be here.
Wait, how much money did you lose? How much money could you have possibly lost, Tom?
Well, you know what? When I hear the amount of money that I lost come from the lips of people on Price Action Live or in Reddit or anything like that, then I will feel comfortable revealing how much I lost. But until then...
You mean when they say it's too low? How much they lost is too low?
They go, I lost $20,000. Oh, I lost $40,000. Oh my God, I know what I'm going to do. We're actually going to go over like at least one story of that today. And what I think is, oh, that's cute. Oh, that's cute.
I mean, it's not cute. You know, it can hurt people.
Of course.
Yeah.
I'm saying that the hurt that I had.
I mean, I heard 250,000. I think it was
adorable.
Randy Baines who's talked about he put in 250.
That's cute.
No,
so cute.
That's a lot of money.
It is.
That's enough money to be like to be upset and sad for the rest of your life. Like
correct. So you can imagine how I feel if that number to me is quaint. if all I had lost was $250,000, oh my God, you know how happy I would be right now. But I just woke up and that's all. It's the same account I had, but I was only down $250,000. One, I'd hit sell right now, and I would dance my way to my family, to my friends, to my wife. I only lost $250,000, and they could be like, "What? You lost $250,000? You don't understand." There's another timeline with a different Tom who works for TradersPost.
But the amount that you lost, it fixed you. Tom, you had demons.
That's right.
And you got fixed by that loss.
Correct.
Mike talks about paying tuition to the markets. Like, it ain't just tuition. It's an exorcism.
Correct. Hey, that's a great line. Did you come up with that, or did you steal it from Twitter somewhere?
No, I came up with it. I'm sure somebody else has said it. Hey, Aventura, good to see you. Greetings and salutations to you as well, listening in from work. Well, so am I. I can't believe this is work. This is crazy. Good to see you. Yeah, Tom, you were saying.
Yeah, so before I'd have problems like I can't stop pressing the button, or I'm doing this mistake or whatever. I mean, I still make mistakes, but my mistakes is I no longer chase what could have been.
Mm-hmm.
I'm upset about like mistakes that I made where I second guess myself or whatever. I didn't follow my rules, but I no longer, if I'm in a trade and it could have made $10,000, I'm a little peeved. But if I just broke even at zero,
Right.
I go, wow, it's a good day though. It's not a great day. It's a good day.
It's a good thing. Yeah.
Yeah.
I totally get that.
I was telling Mike this on Price Action Live. Like he had run up a position, let's say $500, and then he stopped on and he got like $60. And he's like, oh, I'm only up to $60. I go, no. You're up. Your average negative loss. When you normally lose 1,000, you're up 1,060. That's what you're up.
Right.
But you can't see it that way. And I see it that way all the time.
Now it's crystal clear.
Yeah, crystal clear.
Should I tell them the story about why we stopped going to the casino together? Or is it not story time right now?
Not story time. We're plenty of stories coming up in a little bit. So we'll touch on those. I've already, living here through the torment of my own past exorcism. We're going to visit some other people's things. We're just going to touch on some of the levels that we were taking a look at. If you guys know me, I'm very macro focused. I look at that to find. I want to know what season I'm in the markets. Yeah. When we're day trading or swing trading or what have you, you're thinking short term. You don't really care about that so much. If you're not really trading around event risk like CPI information or Fed days or whatever, you don't really care so much. But I think it matters to know what is the season that I'm in. If it's winter, it's very different than when it is summer. So we start off here when we take a look at the US dollar, which is always my favorite indicator to look at. It's a coincident indicator for financial conditions right now. But because it moves so slowly, the trend that you see there is really going to play out in whatever you're dealing with. So if the dollar is going up, equities will generally be bearish, and opposite if it's going down, generally speaking. Right now, just all of a sudden, all my profit accounts like closed, and I heard the market is closed, order filled, market is closed, all in my ear, all at once.
Oh, I see.
Whoa, that just completely shocked me. So the dollar tells you what season you're in, and right now we were in a consolidation range with a bias towards the upside because we made higher highs, but the dollar did break back down into this trend area over here. So we're still like on a nice edge, not really knowing which side we're going. Essentially, as long as the dollar stays below 101 on the Dixie futures and above 95.8, which is a large range for the dollar, we're pretty much going to have chop within the markets and not like a steady trend in one direction. But we did move from bullish trend to neutral trend on a long-term dollar chart. So that's interesting. I would have expected way more of a decision one way or another, but hey, this is where we're at. So when I see stuff like this, I'm expecting choppy days inside of the markets. Scalping.
Weren't we here just, I feel like this is a repeat. Weren't we here just in May? Was that same May?
Yeah, we were here in November. We were here in October. We were here in July, August. We were here May. And we were here in April. So basically, sideways chop for the dollar since April of 2025, which is what we saw in markets. Even though we got all-time highs and stuff like that, it's been pretty choppy. If you take a look at the NASDAQ over here, since April, that's over here, April 2025, that's here. So basically from over here to over here, it's been generally up because markets generally go upwards, but it's not in the same sort of way as we're normally used to with large up moves. Let's see here. We had years of just continuously moving up without any of these big shocks inside of it. Shocks like this, shocks like this. Like we had that for years, and now we don't necessarily have that. Even though the markets are drifting up, let's not get it twisted. All right,
do you think there's an AI bubble? I want to talk about that later because I keep hearing this talk, AI bubble. But then when you hear about the breakthroughs that are happening that haven't hit the technology yet, it's just breakthroughs behind the scenes, efficiencies, new designs. And I'm thinking, how could this actually be a bubble? It's very strange. And then you get Gemini 3 that comes out that basically puts Photoshop. I mean, what you can... Anyway, I want to talk about it later. If your thoughts on if you think there's a bubble here or not.
No, I don't see a bubble at all. There's no euphoria in the retail markets. We're not seeing crazy money chasing after these stocks, crazy valuations. We're not seeing that. The valuation that we're getting, like we got, what is it, 5 trillion on Nvidia, but you'd be hard pressed not to say they earned that.
Right.
They had revenues of 55 billion the last reporting. That's not pets.com. All right, that's not Herbalife. And so I'm not seeing the bubble at all. And in fact, retail, because we're in a K-shaped economy, where since COVID we had this bifurcation where those who have more and those who have less keep having less, we're not getting the retail fury coming into that space.
Right.
We should see that euphoria be tinged inside of the crypto markets, and we're not seeing that. We have Bitcoin it just dropped now below 90,000. Like, that's not where we're at right now. Where is this euphoria from retail markets, right? Bitcoin as an indicator for liquidity, like the movement of money throughout the system. We're not getting that over here. Bitcoin broke to 125 all-time high. Yeah, that was okay, but this is nothing like the euphoria we saw here in 2021, 2017. Like, we're not in anything like that. So where's the bubble? All right. So as we talk about the dollar, it is important to talk about bonds as well. I'm not going to spend too much time on that because I do realize, after I talked to several other people, they could care less about bonds.
You think?
I don't know why. The bond market is 10 times, 100 times bigger than the stock market. It's trillions and trillions of dollars, and it's the way your governments finance themselves. But yeah, let's take a look at Microsoft stock. That'll really tell us a story of what's going on. So we have here, if you take a look at my chart, all the different colored squiggly lines here. The redder the line, the warmer the line, the more short-term that bond is, generally speaking, and the longer ones are cooler. So what we have here is that the short-dated bonds are falling, the 1 month, the 3 month, the 6 month, the 2 year, and the longer rate bonds, 10, 20, 30, those guys are moving up. All right. What does that mean? This is what's called a bear steepener. Right, it's called a steepener because we have the yield curve. Let me see if we can show you that here. The yield curve here is a steepening, right? The spread between the long-term yields and the short-term yields are steepening, and so, but it's steepening. You can have a steepening that happens in two ways. You could have a bull steepener where it's the short-term rates falling and long-term rates are falling, right? But the short-term rates are falling faster. That means that means the Fed's going to cut. The interest rates are going to be coming down. That's what we were used to for 15 years after the global financial crisis. And the idea is that more liquidity and more money is going to be stimulated and pumped into the economy. When you have a bull steepener, when both interest rates are going, let me do it this way. When both interest rates are going down.
All that just for that move. I like it.
That's right.
You committed to it.
That's right. And so that'll make the yield curve go up. It's not the yield curve. The spreads go up, but the yield curve go up. But if you have a bear steepener, what you have is short-term rates going down and long-term rates going up. So if long-term rates are going up, that means there's inflation expectations in the future, or there could mean that. It could also mean growth, but inflation expectations in the future. So your money's going to be worth less in the future. That's where the interest rate needs to go up. And short-term rates are going down because the Fed's going to have to cut. Right, the short-term rates are being affected by Fed policy because, one, they're setting policy, then they set the different controls in order to keep rates down. They have different things that could help keep that down. And so this is not good for the economy, bottom line. This means that there's trouble within the economy that is going to have to be dealt with. But how you deal with it, because if you cut interest rates, you're going to increase the likelihood of inflation in the future, if your idea that you're stimulating the economy. And so longer-term interest rates will go up even faster. And eventually, they're going to pull short-term rates up because the short-term rates won't necessarily be pinned at some low amount, and the long-term rates will go up. Eventually, the cost of money will go up higher and higher. So this is problematic for the Fed, which we totally understand. We've been looking at that for the last few months. So economy bad.
Economy bad.
Short
and sweet. You talked a lot about bonds, given that you said people don't care about bonds. Ventura says, I like Barry bonds.
Is that a chess player? I don't know.
I knew Tom would know. It's a sports reference. All right. Well, cool. It's so good news, bad. What'd you say? Bad news?
Well, it's usually bad news is good news for the market because it
Right.
means the Fed will stimulate. But this is a type of bad news that means they can't stimulate because then they can make the bad worse. The thing that's bad is the inflation.
So are they
So
going to cut?
So even Kevin Hassett was out here, the guy who apparently is going to be replacing that the poly market has like high odds that he's going to replace Powell, is saying we should cut, but cautiously.
So
Which means
what, 25?
25, or maybe not even at every meeting.
Man, these guys got to shit or get off the pot, man.
Well, look, if let me just head over here and just let you know here. Let me just jump to 1 second.
This whole Ross and Rachel, will they, won't they, you know, they kind of kiss, they don't kiss. Like, what the heck is this?
All right. Here's a good summary of a post here. This is a post from Endgame Macro, which was a reply to Daniel DiMartino's Booth post on the 2nd. So she was asking, and if the Federal Reserve imposes ZIRP, so zero interest rate policy, will that send money rushing in off the sidelines given demographics? So given what's going on demographically, given what's going on in the economy, if they do cut and they're trying to stimulate the economy, is money all of a sudden going to rush into markets? So, quote, cash coming into risk phase doesn't happen in the middle of a downturn. It happens after damage is done, and this chart is telling you we're not there yet. So Endgame Macro expands on this and says, I think you already know my answer. Nope. If the Fed is back at zero, it's only because the economy has already taken a real hit with unemployment rising, credit breakdown, and households shifting into survival mode. And if that kind of environment, ZIRP doesn't magically pull money out of safety. We've seen this movie before. In 2008, the Fed slammed rates to zero and launched QE. But money didn't just rush into risk. This is equities, crypto, Bitcoin, all that. It hid in T-bills and deposits while job losses piled up. Same story in the early 2010 years of ZIRP, yet the big flows were into treasuries and high-grade credit, not speculative assets. Even in 2020, when the Fed went straight back to zero, the first instinct was a scramble for cash until people were convinced the bleeding had stopped. The psychology never changes. Money moves into the risk after the damage is done, and people believe the recovery is real, not just because the Fed flips the rate switch. And given today's demographics and debt load, that hesitation window is likely to be longer, not shorter. So the idea that the Fed needs to cut is that usually happens around the time where we have a downturn in the economy and a downturn in markets. That's usually the sign of them cutting, right? When the Fed cut interest rates February 2020, the stock market fell because they're admitting there's a problem, especially when they cut drastically. So we'll see what they're going to be doing over here, but things are not looking particularly well when it comes to that front. Actually, let's just run over a couple of these things. So we had the inflation rate coming in at, let's just go take a look at that on the calendar. So we had the core PCE and PCE data that came in today. So we were at previously about 0.2, forecasted 0.2, actual 0.2 for core PCE. We had even year over year, it actually dropped by 10 basis points to 2.8. And then we also had the PCE price index stay flat, 0.3 for the month over month and 2.8 or so for the year over year. What does that mean? That means in an environment where we're seeing inflation, right? We're seeing inflation day by day. We're seeing it at the grocery store. We're seeing that sort of thing. Still, the inflation rate's not increasing. So if it isn't, that means it's being offset by capital destruction, by disinflation, by deflation, right? If you have inflationary effects, but the inflation rate stays the same or falls, then you are in a deflationary environment. That means money and credit is being destroyed.
That's not good for the economy.
That's not good for the economy. Well, not in the short term. It's painful. I don't want to talk about good or bad. It's painful.
I mean, hiring down, business expansion down, investment in risk business down.
Yeah, because anything that's over leveraged and everything that's not generating enough cash flow, all the things that are more risky, they get washed out. So absolutely. Yeah.
And is this why Bitcoin is not, or the meme craze hasn't happened?
That's, to me, is the big canary in the coal mine.
Right.
It's not that Bitcoin's not like flat. It's down. We're seeing massive liquidations. I know the chart doesn't look crazy, right? Bitcoin falling from 125 to 89. But the way it's happening, the speed it's happening, and the amount of liquidations that's happening within the future space for crypto and the perpetual futures is massive. Massive, massive, massive. We have what here? We're at the Bitcoin liquidation map. If we just take a look at CoinGlass, just to get a quick look at the Bitcoin exchanges for Binance, OKX, and Bybit. If you take a look at that over the last 30 days, you'll notice that longs are at 161 million. So there's barely any leverage longs. And it's massive short. We're at shorts at 11 billion. But you remember we were seeing 15, 17, 18, 20 billion constantly for the shorts for months.
Right.
Well, those guys keep getting washed out. They get washed out, and the shorts get put back on. Washed out, shorts get put back on. So both the shorts and the longs are being liquidated constantly, while we're having this downtrend. And Bitcoin is now below the yearly average here. My yearly volume-weighted moving average is what I take a look at to see if Bitcoin is going to bounce, and we're below it. So as long as we're below 95,000, 98, what is this over here? Yeah, 98,000. To me, it's bearish, and liquidity is headed down. So in a little bit, I want to come back here and talk about what we can do as traders. I do think that in an environment like this, and we're going to listen to Carson talk a little bit about the case for a topping pattern for the stock market for the next 10, 15 years. We are in a trader's environment, which is why I think TradesPost is doing so well. You're going to have to find a way of trading, or if you do find a way of trading profitably, it'll be one of the income sources that you could depend on that doesn't require you to have some business or someone giving you a job or what have you. It's money you can earn yourself through your own merit. But we'll take a look at that in a second. First, let's take a word from our sponsor.
Looking for a prop firm that actually plays nice with automation? Meet Blue Sky, built for serious traders. And with TradersPost, it just clicks. You connect Blue Sky inside TradersPost. Route your TradingView signals to paper or funded accounts, and let it auto-manage entries, stops, and targets. You control risk per trade, filter by session and symbol, and pause or resume with a single switch. Every fill is easy to review in one dashboard. Funded accounts can request payouts daily with launch plans starting at $49. Get funded with Blue Sky. Execute with TradersPost. Apply today at bluesky.pro, BLUSKY.pro, and plug in your edge. Trading involves risk. Use proper risk management.
You're muted.
It wouldn't be after hours if we didn't have a quick jump into Carson Corner. That's right. So we'll take a look at what Carson has been saying for the markets, what he's predicting for markets. Is he right all the time? No. But if you follow people who have a good head on their shoulders, access to information you don't have access to, and you pay attention to the rate of change of the things they're predicting, it can be super, super helpful. So this is an interview that Carson did on Thoughtful Money. It came out yesterday. Let's hear the first little part for the intro, and then a little bit when he talks about potentially the topping pattern that markets are going through right now.
Is my view that we are in a broad topping process here. I think valuations reiterate that. I think there's all kinds of reasons to believe that even though it is very hard to call to the week, to the month, the quarter, or even sometimes the year, we are getting very close to another kind of move down that is going to, when you zoom out over a decade, going to look like a lot of chop back and forth.
All right.
Understand that we are not in Kansas anymore. This is not the same environment of, a Fed-dominated, globalization increasing, tech, low interest rate environment, right? A tech-driven world. Now, some of those things are still with us, but I've been very clear that the way we're likely to move forward here, which, in my opinion, and I've been very clear about this, is driven primarily by a demographic and populist kind of impulse. Even though it will be through many quarters and years of counter trend things along the way, are largely going to be a period of rising interest rates, of increasing inefficiency, deglobalization, increasing global conflict, a period of likely towards the end slowing antitrust and slowing corporate earnings growth. That sounds really scary, and it's not going to happen overnight. This is a big process. But again, we started really talking about this in 2021.
He's talking about bear market,
and again, correctly called it 22, almost to,
He's talking
to the
about
week.
the topping of the financial market. So what is the topping pattern that he's talking about? You can imagine, for example, let's go to the S&P.
I mean, he sounds like he's an oncologist giving you some bad news.
That's just his tone of voice. That's just how he speaks.
That's not how he usually sounds.
It's how he sounds. If you want to, let me just switch over to my chart here real quick. So, let's say we take a look at the S&P over here. This is a topping pattern. It's a topping pattern. Even though we had still all-time high, all-time high, all-time high, all-time high, the pattern is topping and then we fall, right? And this happens again and again. We see this all the time. This is a topping pattern. This is a topping pattern here. So he's saying, hey, it doesn't mean we can't have all-time highs in markets, but what's happening is the shifting within the economy towards this populist movement, which is populism is a redistribution of wealth from the wealthy from the 1% to the 99%. And so if that's going to be happening, we're going to be seeing deglobalization. We're going to be seeing a rejiggering of policies. We're going to be seeing redistribution of wealth, and that's going to be poor for the different entities, the corporate entities that took advantage of the zero interest rate policy world for the last 15 years, and then the next years will be different. Higher interest rates, right? If you have higher interest rates, then banks can start giving you savings interest again. So you can actually have
that's never going to happen.
I'm just saying that opens up that possibility, right? We go, well, we need to solicit people, so let's give them some of the interest rate because now they can get a bond for 7% as opposed to at 0%. So if they could buy that, well, they can give you 1% interest,
right?
2% interest. Well, if you can do that, well, then people are going to save more. Well, if they're going to save more, they're going to spend less, but then they'll have a different point of view of markets. They'll spend more time in the economy. They'll do more things that can generate wealth and productivity because they know storing that wealth will give them a guaranteed interest rate for at least 10 years.
If inflation is low.
Well, even if it's not, right? If you need to counteract inflation, let's say inflation is 8%, let's just say, right? And bond yields will get you 5%. Well, you'll do something to cut into that inflation, right?
But the saving of money, you don't want your money to be devalued. You save your money for 10 years. It's worth less at the end of that 10 years.
Well, because you could have different structured products that happen. So you can have, let's say the interest rate is, let's say, we're at 6%. And on 6%, they then do a structured product with different options that generate another 4% interest. Well, then you can have products that are yielding 10% interest that will beat the 8% inflation rate.
Right. I get it.
So those things would be desirable. Well, that's a very different environment than YOLO into Bitcoin or buy Apple at any price. Very different environment. Plus, if we start having job losses and AI and all that sort of thing comes into play, well, then the passive investing, which I think this year hit 52% now of invested in the stock market is passive investing. That means the majority is, the majority is not a super majority, but the majority is passive investing. If that starts turning the other way, where unemployment starts going up and the amount of money flowing in from 401ks and weekly investments and all that sort of thing, Vanguard funds, that disappears, well, then you have the market going down precipitously.
I'm having a hard time believing redistribution is going to happen with AI. That's just going to be, it's going to suck everything in. Like that in robotics, it's going to suck everything in. Job loss when it comes to driving and factory work. Never mind the other industries. Retail, goodbye. Mom and pop shops, AI is going to change that whole conversation of redistribution. Sam Altman's talking about there's going to be $100 trillion in AI, and OpenAI expects to get the lion's share of that. Well, that's a great way of saying good luck to everyone else.
We don't know. That's the whole thing. Elon Musk was just on an interview last week, talking about how energy will be the unit of currency and not not productivity.
And then
So
China's going to do well there because they are blowing out the energy with their solar panels. They're producing way more than the United States. I mean, it's wild.
but that all means a rejiggering of the existing system.
Right.
And so at least a period of volatility, which should come with those who did benefit in the previous system don't benefit in the new one. So maybe that's not what goes up. You know, just before you put your money in GE stock, why wouldn't you put your money in GE stock? And then now it's like, well, no, you put your money in tech stocks. Well, now it might be something else. What's
Right.
going to be the next thing? So he goes on in that video to talk more about the idea of, hey, if you knew that what the zero interest rate policy would be from 2009 till now, that it would be zero interest rate policy because of the demographics, because of the economy, because of the structural fiscal and monetary flows, well, then you made gangbusters money because you knew what to invest in. High growth, you didn't worry about value, you could hold, you didn't worry about valuations, all kinds of stuff as the stock market went up and up and up. Where there are people who, in a shift-like fashion, shorted all the way through. Right? Well, if now you know that you're going to be in a high interest rate environment, high and rising, and that it'll be a populist movement with no zero interest rate policy coming, well, you'll have a different point of view over the next 10, 15 years. And if you're able to figure out what to do there, well, then also you can make gangbusters money. But we're not hedge funds here. We're not macro heads. I want to turn to what real people are doing in order to try to make it through this world. We talked about the K-shaped economy. Hopefully we can get Darius Dale from 42 Macro on here to talk a lot about that because he talks about KEC quite a bit. But the idea here is that people are looking for other ways to generate income because, one, they cannot necessarily rely on their job, and two, the money that they're making is not enough to beat the cost of living. So they're driving Uber, they're doing drop shipping, they're doing content online, they're doing OnlyFans, they're trying to do all the things that they can in order to generate more money. And one of the ways that's been popularized since COVID is trading, is absolutely trading. And people, once they figure it out, are making 10, 15, 20, 25, $50,000 a month in a way that they never could sit in their cubicle answering the phones doing retail.
But not most people.
Not most people.
Failure rate is what, 90%?
Yeah, but it's like the OnlyFans people. Was it less than 5% of them are making, you know, the massive money that you're seeing? Most OnlyFans people are making $183 a month, but they're trying anyway.
I get it. No, I get it.
All right, so there's two stories that I thought were, actually there's several stories, but I want to go over two stories that I thought were interesting, just something to keep in mind, because I do advocate for people to learn how to trade. At least the knowledge is very, very useful. And I am a proponent of thinking that there is a style of trading, a type of asset, a time frame, a type of risk that's suitable for every person, right? In the same way that I would say if someone went to school or whatever, they'd be like, oh, there's no job for me. No, there's going to be some kind of thing for you. You just got to find the thing that can work for you. So this is a post that was posted 3 months ago on day trading that I thought was very apropos. He goes, how losing in trading made me lose my family.
Oh,
Guys, I saw it in lots of posts here. Since prop firms get hyped everywhere and influencers post their $10,000 per day trades, more and more people need to be aware of the dark side of this. Here's mine. My dream, same as yours. Freedom for my family, having more time for my daughter. I thought the hardest part about trading would be losing money, blowing accounts, failing prop firm evals, watching stop after stop get hunted. I thought that was the pain. But the truth, the biggest loss wasn't financial, it was personal. The spiral. I started with passion. Charts, day and night, kill zones in London, then New York, alerts buzzing, indicators stacked. I convinced myself it was a grind. In reality, it was an obsession. I did a course for $8,000. I had built a good buffer since I was lucky with crypto in 2017. The time I sat in front of screens with my daughter grew up in the next room. Presence, even when I was there, I wasn't really there. My mind was always on the last trade, on the next setup. Emotions, a red day followed me everywhere. At the dinner table, into arguments, into bed at night. Isolation. Instead of opening up, I pulled away. I'll fix it tomorrow. Next week, I'll make it back. Lies, I told myself and to her. The account went red, my energy went red, and the relationship followed. The breaking point, the day we separated. It wasn't about money. It was about me not being present, me not listening, me being there physically but gone mentally. She didn't leave because I lost a trade. She left because I lost myself in trading. And now I live with the hardest truth. I don't get to see my daughter every day. She's 4. Every missed bedtime, every morning without her smile cuts deeper than any drawdown I ever took. This hurt more than the money I made with crypto, and lost it all, of course. Peter. There are some sad stories in the trading world.
Yeah.
But here's the thing. Yes, there are people who have a compulsive mind. They'll gamble, they take out risk, they'll bet for tomorrow. But I've seen stories like this many times over, where the reason they're doing it is that they're just not making enough money in their daily life. They don't see any way of getting forward. Right? Mike Green had a post recently talking about the idea that $140,000 per year is now the new poverty line. Below that, you feel like you can't get ahead. I mean, forget a house, forget any of that. Forget moving to a better place, you're screwed. And people feel like they need to be able to get over that hump. And so I get it that they're taking to trading in order to do that. One, I just want to tell people that is not the way that it needs to happen for you. All right? That's not the way that it needs to happen. There are other ways that it can occur, right? And we working here at TradesPost, we see this all the time. We see people successfully trading, right? I thought there was almost nobody being successful, that you couldn't, that it was mostly a scam. There's no point in doing it, until I started working here and I realized, oh, no. We talk to people every week where they're successful. They're making a killing, making a life for them trading. Here's a story from Daddy Day Trader.
Are you reading all this?
Yeah. So it says here, sure. I was an aberrist for over a decade, but I always craved more. So I started out just investing in good companies in 2019, one of which was Tesla. We all know how that went. I started stacking cash and that felt good. So I stacked more until I was comfortable enough to start trading options. I went the stupid route that everyone did back then, like in the Wall Street bets. I caught some of the AMC swing trades with both puts and calls, as well as the Rocket Mortgage trade, which was 1,000% plus gainer. And that was when I started climbing Mount Stupid, because I thought I had figured it all out. Turns out I didn't. I got lucky. So then I started losing money with options for a while, which caused me to start researching more techniques. See, this is where he turned the other way. I didn't go down the path that the other person did, where they just pilfered it all. I went down that rabbit hole for a while and kept getting gradually better with options, while also invested in quality companies and building my nest egg back up. I was also making really good money at my job at that point, climbing the ranks quickly. In 2022, it was when I started doing more day trading. My portfolio was looking great, so I could put some risk on the table. This is smart. It was better long-term. I took some of that money. Hey, let me take 10, 20% and do risky trades with that. I was flipping weekly, bi-weekly calls and puts on SPY and making some decent profits. Sometimes in 2022 is when I started looking more into futures and trading some prop accounts. That was an entirely different animal, and it took me a very long time to figure out how to trade within the rules. Futures really do require you to be an actual day trader because of the leverage and speed at which they can move. In 2023, my wife went on bed rest because of pregnancy complications, and I had to quit my job to take care of her. That was when I went full-time trading. All that time building up my nest egg prepared me for the opportunity that presented itself. So there I was taking care of my wife and trading every day. Son was born a couple of months later, and after my wife had to go back to work, I was a full-time dad and day trader. Hence the name of my company, Daddy Day Trader. I stockpiled cash for quite a while, and in the first 2 weeks of April this year, I deployed $120,000 into some more investments for my portfolio to take advantage of that amazing dip opportunity. Now I just had my second kid, pull the other one out of daycare for the summer. Wife is on maternity leave for 3 months, and I can enjoy my time with my family, trade a couple of hours when I have time, and just live my life.
Huh?
C'est la rêve, it's their dream. The dream of any trader to live this way. Right?
Yeah, it's pretty
and
good.
So people, if they have discipline, if they find what works for them and they're able to manage their emotions, this type of future is not unheard of. It is actually quite prevalent for the people who are able to do it. Right? You just have to have in your mind this idea that, hey, you're Sisyphus pushing out rock up the hill, and that the hardest part will be that last 20%. Don't roll back down the hill. Just keep on going. Don't even think about how far you're going. It's sort of like the runners who they're in a race and then they get close to the finish line, so they slow down a little bit, and the next guy passes them.
Do they do that? Is that a thing?
Yeah, you're trained when you're a professional runner. You
Run
gotta imagine that you have twice as long to go, and you just keep going, because otherwise your body will just completely betray you, and you'll stop while you're doing it. And we've seen on Price Action Live, as we're trading, me and Mike, that we'll be up on the day, and we'll think that our poop don't stink. Oh, that went so well. Had I put on an extra 3 minis, had I put extra 3 micros, maybe if I put a mini, I would have made so much more money. Oh, it would have really made my month. Let me go ahead and put that on for the next trade. Boom, lose it all in one day. So I get it. I get both ways. But if we're in a top-end pattern, if what's going on with the economy makes sense, you're going to have to use your interests in markets and parlay that, if you can, into a way of generating revenue. Because I don't know how people are going to survive if they don't have multiple revenue streams. What about you?
Well, yes. And what I'm actually more interested in here are trading bots. I know you're having some success with your bots. That's something that, especially with AI now, I feel like it's more approachable to me. So I do want to spend my time in the coming year learning more about creating bots. I'm in love with the Alpha Arena, NoF1.ai, that whole process. And as AI gets better and better, I wonder if that will make trading with bots a lot easier and maybe make trading accessible to people like me who don't have a mind for the charts, who don't have a mind for these numbers and all this data, but are willing to put in effort in conjunction with an AI.
Yeah, so if you show my screen here, this is my, just for this week, this is my bot running, and it generated $783 for this week. Peter, this is all automated, right? These are all automated trades. If I just take a look at the trade list, this is my trade list down here. And when I see this, okay, I see it's a 5-step forward, 3 steps back situation. But for myself, on the days where I were trading and I was getting these reds, I would go on tilt. I would go on tilt on these things. And then I would end up trying to chase back in order to gain. But because I'm using TradersPost and I've created an automated strategy, which I thought used to be that it needed to be super complicated. It doesn't. It just needs to have a simple setup with proper risk management and patience, and then it works. It can work. Now, does every single one of them work? No. I get it. But they do exist out there, and you don't need to have be a mathematician in order to be able to figure it out.
Does AI factor into this at all?
AI is how I made the script. So I don't even program these strategies or indicators by hand anymore. As you guys see on Blueprint on Thursdays, I use a AI tool in order to do it. You guys can get it for free. PineScript Agents available in the back end of. Actually, it's not there yet. It's going to be up there soon. But if you go to our YouTube channel, you'll be able to find it. And you can even get the indicators, the strategies. So like one of the strategies I'm going to be doing, shoot, never mind. It's not up there yet. It's on the YouTube channel. But essentially, you could go back here and grab indicators, grab scripts, and try to test them out. Say, hey, depending on the different risk parameters I want to do, depending on how much I want to bet, depending on the size of my account and what drawdowns I can have, let me see if I can generate an automated strategy that has good results over multiple different market regimes, find it, and run it. It doesn't cost anything to try to do that. And what if you pay for an eval account at whatever, $50, $80, and you see what it generates. You don't have to be like these people who just degen gambled their way looking at YouTube videos until they lost $50,000 in their life. You don't have to do it that way. All right, Peter. I said my piece. I want everyone to be successful, because the more successful they are, the better the economy does.
That's true. That's true.
All right. So we'll be back next Friday.
Hey, quick question, Tom. Can undocumented immigrants trade in their home country?
Well, not if either the broker or the prop firm account doesn't allow for that country.
I just keep imagining, like, what if the undocumented or whatever you want to call them, they start taking your trading, like they become successful traders, so they take your trading job, but they can do that anywhere in the world. Um, can
Well,
deport
the
them
Indian
from their own
market does
country.
that, but they have their own markets. The Indian market is giant. What's funny about the Indian market, I haven't checked it recently, but it like only goes up and to the right. And it, because they have all these rules of how long they have to hold the stocks and how often they could trade. It's way more restrictive, and so it lends itself to the stock market going up and up and up and up and up and up. So it's very interesting. Like, well, I guess I'll just buy and hold. Mike was talking about that on Price Action Live. Even for United States, he just bought one micro in his futures account and just held it long.
Right.
I'm just gonna be
I
long
heard you say
US this whole, and he was up like 1,600 points over the last couple of months, which is pretty funny.
Yeah, I was just wondering if people in other countries, maybe countries that they're having trouble in, if trading is an option for them. You're talking about how trading is important for people to do. I know that in Canada, United States, and these Western countries, but I wonder if you're coming to America because you need a better opportunity. I wonder if trading is like an option for you.
Absolutely, 100%.
Donald Trump should start teaching people in other countries to trade, and then he doesn't have to ice them. Anyway, just a thought. I don't know.
All right, guys, that's it for us. I will be back next Friday. On Tuesday, we'll be doing Price Action Live at 9:30 a.m. Eastern Standard Time. So if you want to see what it's like to trade live using the TradersPost platform, the most advanced trade execution platform known to man, you know where to find us. We're here for strategies. We're here for ideas. We're here for a shoulder to cry on and for someone to cheer with you when you succeed. That feels pretty good.
Oh,
I
that's
like that
sweet.
he said that.
Christmas
I'm a good person
spirit.
for saying that. All right. Thank you very much and happy trading.